So this is Self-Made Millionaire Tips, Colin Plume, CEO of Noble Gold Investments. And I have Jay Levy, who's the managing partner of Zelkova. Did I say it right? Zelkova.
Second time's a charm.
Zelkova Ventures, which you just explained to me, which is interesting, is named after a tree.
Japanese tree that's very fast growing and hardy. We thought it'd be a good name for a venture fund.
I think
15 years later, it's proven right.
Yeah. And you said the URL is available too, which obviously is a big decision making. You got to get something that you can get too. So that's important. Jay has invested in 90 startup companies with 35 successful exits since 2014. What were you doing before 2014? Were you doing the same thing or?
So we started in 2017. I went to Rutgers. I'm 42 now, so graduated 2003. I was at Morgan Stanley briefly after graduation. I interned there for 2 years prior to graduating, and then was one of the first people at a financial service consulting company that got sold. And then I saw an opportunity in New York to start doing early stage venture funding. The words early stage probably didn't exist. Seed stage didn't exist. Pre-seed definitely didn't exist. It was friends and family. And that's when my partner and I decided to launch the fund.
And so when you guys are
wait, I just totally screwed something up. I took off a 10 years, 2007, not 2014. We started in 2007, 2008, which was a great time because we were in a recession to start a company.
Yeah, that is a good time. That's a great time to start a company.
Right? We're off to a great start here.
All right. Should we start over or do you want to keep going? No, we're going. All right. So 2008, 2007, you're in seed early stage investing, which wasn't common out there.
Yep.
And so why did you know that there was a niche for this kind of funding? What was kind of the aha moment for you that you're like, hey, we got something here and this could be successful?
So the aha moment really was that on the West Coast, you saw all these angel investors and early stage people would write $100,000, $200,000 checks, $300,000 checks. You didn't have that in New York, even though we have a ton of wealth in New York from finance and whatnot. It wasn't from technology back then. That's obviously changed. I used to attend the New York tech meetups and I see these great companies pitching and trying to raise $300,000, and they'd go to some of the funds that were in New York that were later stage funds, and they'd apply the same rigor and regiment to diligence on a $500,000 investment as they would a $5 million investment. A company looking to raise $500,000 in an early stage company is going to have a lot less data points typically than a company looking to raise a Series A or Series B or later. So that's where I saw the opportunity. And the edge really was back in 2007, 2008 was we were writing checks. Today, you need a real edge to compete in this business as it's gotten more competitive and harder. But back then it was, we're here and we were very collaborative with others also.
So there was an opportunity in New York. There wasn't as much of that type of investing happening. And like you said, I've looked at, early businesses. There's, sometimes a business opportunity comes up and the opportunity is great and they're already in stores and things are happening, but the owner may not have all the data that, some of the other requirements have. So I've seen this myself too. It's at different stages for a lot of investors.
The ecosystem just didn't exist in New York at the time. Techstars hadn't launched here. They were still a few years out. First Round Capital, a pretty well-known fund, was sending partners from Philly. He had a handful of investors here, and that's it. Not necessarily like it is today in New York.
Yeah, interesting. So you guys got rolling kind of in 2007, 2008. Then obviously the economy sort of fell apart. What were you still able to raise money? Was it a challenge? What happened during 2009 to 2011? Did it present opportunities? What happened during that time period?
Yeah, I think it's a really topical question because we're seeing a similar time period right now in things. And frankly, some of the best vintages we'll see of companies will be starting now, just like they were in 2007, 2008, just like they were when we had a downturn in around 14. Like the best time to start a company, well, feels like the hardest time, is in a slower period, a downturn, whatever we want to call it, we're in now. So we're super excited about what we've done, what we're doing now. We were super excited about what we were doing in 2007, 2008. When we weren't as excited, we're 2019, 2020, 21 in the chaos. And frankly, we sat on the sidelines of a lot of deals that we just didn't think we could make money on, right? And that's the challenge, right? There's great companies that can be successful, but can you also make money on it? Ultimately, you need to make returns.
Yeah, and at a certain point, the deal that you love maybe gets too expensive, right? I mean, that's probably a big part of it too. You're like, I love this, but we know there's always big risk when you're doing this, and how much risk can I afford to take? And so how much money are you guys looking to get out into the market? I know this is a loaded question, but how much are you looking to put out into the market in a typical year?
So our strategy, and we can back to that number, our strategy is to invest early and follow on heavily. So we look for companies that are very early stage, raising between $1 million and $3 million, and typically we put in 200 to 500,000. So we work with other investors, we'll lead, co-lead, follow on, what might it be, and then we reserve 2 to 3 times that in any one company. We see about 800 companies a year. We invest in 6, 7, 8 of those from first-time checks, and then we follow on in about the same amount of companies. So we typically want to target about 750 to $1 million in any one company. So we typically do the pre-seed or the seed, which that term is being thrown around quite a bit now and changed, and then the seed extension, and then a little bit of the Series A, and that's typically our time. The most we've ever invested is 6 times in one company. So we do follow on that.
6 different rounds of
6 different
investment.
rounds. Yep.
And was that nerve-wracking to be, or you felt good kind of every round?
You know what? You don't realize it until you're in. You're like, oh shoot, this is like my 6th time committing to this company. It worked out well. Typically, if we're doing that much follow on, we have a high conviction on the company, right? Because to get conviction, time, right? And so the more time, and that's part of our strategy, is we don't put all our cards on the table in the first round. We reserve capital because time equals information, which equals conviction.
Yeah.
So to get that, so those are companies we're highly positive on, have significant conviction on.
And that company, just off the top of my head, my question would be, in through all those rounds, they never could go and get financing from a bank, or they did get financing, but they still needed addition? Because my thought would be, wouldn't you want to go to like, if you're that far in, wouldn't they go to a bank and try to get some, as opposed to giving up a piece of the business? Wouldn't that?
So debt, and you think about going to a bank, within the venture world, obviously it's changed due to Silicon Valley Bank's recent implosion, or whatever we're referring to it as now. But venture is a traditional route. Selling equity is what typically happens, whether that takes the flavor of equity, convertible debt, a safe note, like that's kind of all type of equity. This company ultimately was very successful for us, but like any companies, there's ups and downs. So not all those 6 rounds were up and to the right. There were downturns within the company, and there were times where the company needed emergency funding, and we stepped up, and we were compensated for that, right? In regards to whether it be warrant coverage or whether it be a lower valuation or whatever the terms were of those rounds. So every company is different. The only thing that's similar in every company is it's a roller coaster, and it's not always up and to the right, and every founder isn't killing it, even though the TechCrunch headlines might say that.
Right. Yeah. And and my numbers, I guess, aren't perfect, but it looks like you invested 90 startups. You had 35 successful exits based on what I have here. That seems like a very high ratio. And I, not knowing anything about this world, but that's a pretty high number, right? In terms of exits?
It is. Yeah. We definitely have had a high number of exits relative to early stage funds. And what do we accredit that to? I think for us, it comes down to our strategy. So we tend to look for and focus on B2B software companies. So companies that help other companies do business better. So these could be marketing tools, could be operation tools, could be customer service tools, could be fintech tools, things of that nature. They don't tend to be zero-sum games, right? So Instagram, huge success that we all have heard of, we all love, hate, addicted to, whatever the right word is. For every Instagram, there was hundreds of photo sharing apps that we don't remember the name of that we're trying to launch around the same time during South
Right.
by when Instagram launched, right? Certain markets are winner take all markets, but even look at like the CRM market, right? We think of Salesforce, right? This is a behemoth. Well, there's now HubSpot, right? There's NetSuite. There's companies were invested in the CRM space, Spiro, and there's dozens, if not hundreds, of successful CRM companies. Maybe not the extent of Salesforce or HubSpot is, but B2B tends to be not a winner take all market. Whereas consumer, right? There's Uber and Lyft. Good luck starting another rideshare service,
Yeah.
right? At this point, that's why our strategy. So what we have is we have a lot more doubles and triples versus home runs,
Got it.
and our goal is to get a home run. Along the way, which we have. But a lot of those exits aren't 50 times our money. They're 3 times, 6 times, 10 times, 15 times our money, things of that nature.
So you go for an industry that you can see kind of pretty easily what the need is. And it's, maybe it works in parallel with something you've already done before, or kind of, you have a little intel there. This is your niche. And so the returns aren't the massive ones, but the risk is also much lower, which, but in a way though, I mean, for an investor that's investing with you guys, you're looking at, almost 4 out of 10, let's just say easier math, like 35 out of 90.
Yeah, about a third.
A third is pretty, then, like, hey, if I space out, someone gives you $1 million and they put, 200,000 in 5, they got a pretty good chance that one of those is going to, go up, or maybe they get lucky and 2 of them kind of go up. Is that sort of what people are thinking? Or I was just throwing out numbers. I don't really know.
Yeah. There's a few parts of it. So companies fail quickly and succeed slowly, typically, right? So we're actually a little over 100 companies now, but of the 100 companies, about 35 exits. I would say only about 35 to 40 have actually failed, right? So we probably have in that batch, and 100 batch, we have probably another 30 somewhat active companies still. And those take really 2 paths. They're either the real home runs, right? They're 8, 9, 10 years old. They're doing several hundred million in revenue, and those will be the ones that may go public, right? Very few people start a company, especially, now the SPAC craze is done, and 3 years later take it public. Like, that's not the reality of how business tends to work. So we've got some of the home runs are, still in the portfolio, still working. The failures tend to be quick. So kind of what also skews the math is you want your failures to be your smallest investment. If I invested in a company 6 times and it failed, I screwed up. Right. If you invest once and it failed, you tried, you went to bat,
Sure.
swang at it, even twice, right? Like, but so you tend to hope that your failures are your smallest investments also.
Right.
So you have outweighed capital in your most successful investments.
No, it sounds interesting. And so Jay, so you get 800 pitches a year. Is that what you're saying? Approximately 700 or 800 pitches a year.
Right around 800 a year.
What would be tips for things that make somebody stand out in that pitch for you and your partners? What do you see that typically that makes a big difference for someone that wants to pitch someone like you?
So I think, if you don't mind, I'm going to blend that into also like kind of what type of founder we look for, right?
Yeah.
Like, because those things are pretty intertwined. So a pitch in person, and I know we've gotten away from that in this post-COVID world, but it's time to get back in person. Founders meet the potential investors. I always say, whether an investor has 1 share or 100,000 shares in your company, they can make your life miserable. And there are 3 types of investors out there. Those that will write you a check and add value, those that will write you a check and leave you the heck alone, and those that will write you a check and make your life miserable. Your goal is to get the first and the second one, right? And avoid the third one. And this is a relationship-driven business, right? So you got to meet in person, you got to spend time, go to dinner with them, meet the other founders they're in, and kind of read between the lines, right? Like, is this someone I want to get in business with for the next upwards a decade, right? Do I want to work with them? So I think that's one of the things, kind of getting back to the question, is like advice, like get in front in person. Doesn't have to be the first call, right? Doesn't have to be the second call, but before you take that check, meet. And if the investor doesn't want to meet, question that. Like, why aren't they willing to get on a plane, right? Or make time for you to come to them? So that's the big thing, I think kind of some of the stuff is, it's been covered out there is, really practice your pitch, understand kind of your market. For us, we're investing in people. We're betting on the jockey, right? It's 97% people, 2% idea, and 1% market. Now, obviously, don't test me on that. That is not, it's directionally correct. It's
Sure.
half a joke, but it's true. We're betting on the jockey, right? So, what do we look for? Someone who's got grit, right? They've got drive. They're self-aware. They get what they know and they get what they don't know, and they're willing to be vulnerable and ask for help,
Right.
right? And they don't think they can do it all. That's a big one. Self-awareness. Um, Someone who's focused, not chasing shiny objects. The beautiful part of a startup is it's a whiteboard and you can do a lot of stuff, and you're by default an entrepreneur. You're a little bit crazy, right? You're trying to do something no one else has ever done, right?
Right.
So by default you're a little bit crazy, right? So you might be chasing shiny objects, and it's how do you successfully chase shiny objects while focusing, right? Because otherwise you're not going to give yourself time to succeed and learn. I mean, a charismatic founder is so important, because that's someone who can recruit, someone who can raise money, right? They can really get people around them and see the vision. Now, they also need to be able to execute, right? Like that is critically important, right? Like, give me a top level founder with a mediocre idea and they will kill it. Give me a great founder with a mediocre idea and they'll be out of business in a year.
Mhm.
Right. So it's the ideas. And that's something I think founders don't fully realize is we see themes and ideas. Right now, the big one is obviously AI, right? Like, how many different permutations of using AI is there? Like, it's all about you and your ability to kind of really drive results and have the passion and make the sacrifice. So that's what we look for.
Yeah, I feel like a lot of the AI excitement is for people that failed in crypto. They feel really good about jumping into AI. Like, I know that thing I was wrong about, but this is really
Well,
where things are happening.
if you kind of take a step back, it was crypto to blockchain to AI,
Oh,
right?
right.
Blockchain was we're gonna like save our asses on this crypto stuff by leveraging the underlying technology,
Right.
and now it's all that AI.
Yeah.
And listen, we as investors, there is a herd mentality. It's not good, right? But there is. So like, we're hot on it right now as funds. And it's not that we're necessarily our fund, but the industry as a whole is super hot on it. And
Yeah.
we're speaking with every one of our companies about how are you leveraging automation and how are you leveraging these language models, and because they are changing changing the way we're going to do business, especially these language models.
Well, and I think the nice thing about AI, as you were saying earlier, is that you probably lose your money really fast. So you get that out of the way, and then I'm not just kidding.
I guess.
I mean, no, I'm joking, but that's probably going to happen, right? I mean, a lot of these ideas kind of move quick, and they think they're important, and then a lot of the tried and true type of businesses of just making businesses easier and smarter and more efficient. It's not as sexy as
Yeah.
AI.
I mean, I always say, like, we are not investing in anything sexy. Like, it's like, if you think you're going to have heard of many of our companies, you probably haven't, but some of these companies are doing tens and hundreds of millions of dollars.
Yeah.
And that's okay.
Yeah, no, that's okay. Talk to me about there was one in here that I really wanted to talk about. Superhuman is an email service. Another, and what I mean, when I and obviously you see so many pitches, but I think like, what's going to make another Gmail, what's going to make, what intrigued you about this, and what made you kind of get involved with this one?
Yeah, so Superhuman. So going back to kind of what we were just talking about, how important the founder is. Rahul, the founder, was a second-time founder in our portfolio. So he started a company by the name of Reportive, which we invested in, and LinkedIn had ultimately acquired. And what Rahul and his team did at Reportive was pretty incredible, because this was before the days of easily building plugins for email. It was a real beast to build what they were able to build. He's an incredible product visionary. And when he came to us and a lot of the other investors with the idea for Superhuman. I mean, we are all buried in our inbox. At least I am. You know, I couldn't tell you how many emails were in my Outlook inbox. So it's a big mission. They've done very well with it, and they're going to continue to do well. And Rahul and his team were the right team to do it. So that is perfect example of backing a team that we knew and we had history with, right? Where you might scratch your head and say, how are you going to keep it to Outlook and Gmail? But if anyone can do it, these guys can do it.
And the first businesses he started with you guys, what was the exit on that for you guys? Was it 3 times, 4 times? How did you guys?
So he will kill me if I say, but I will say it was good enough, very good enough to want to re-up and back him again.
That's not what I want, Jay. I want more information.
I know that's what you want, but certain data I can't give out.
Okay, great. Well, listen, we got more to talk about, but we're going to wrap up this one. Thanks, Jay. We'll get into more details on the next podcast.
Thank you for having me.